My name is Morgan Dietrich, and this is my financial analysis of three industries containing 15 different companies within those three industries. My first industry is Aerospace and Defense industry. In this industry, we have Boeing, which is an American multinational corporation that designs, manufactures, and sells airplanes, rockets, and satellites worldwide. The company also provides leasing and product support services. We have Arconic, which was recently acquired by Alco Corporation. Alco is an American industrial corporation and it is the world's sixth largest producer of aluminum. Airbus is a European multinational corporation that designs, manufactures, and sells civil and military aerospace products worldwide. And Lockheed Martin is an American global aerospace, defense, security, and advanced technology company with worldwide interest. They're the most global, I think. The merger of Lockheed Corporation with Martin Marietta formed in March of 1995. United Technologies, the last one, recently proposed a deal to acquire Rockwell Collins in 2017, which is the biggest deal in history, and they project to generate more than $23 billion in revenue going forward. First, I want to discuss the short-term solvency liquidity ratios. We can see that Arconic has the best current ratio, but we only have 3 years of data from Bloomberg due to them being recently acquired. So I would extend credit to Lockheed. We know that they can pay it back because current ratios is current assets over current liabilities, and their ratio is greater than 1. Arconic is the only company with a quick ratio above 1, so we like them a little better. And for cash ratio, Arconic looks the best, but again, we only have 3 years of data. Long-term solvency and leverages. For this industry, we can't be really concerned with debt because of the substantial nature of the investments that the companies have to make. But with the equity multiplier, we can see that Boeing has increasing debt in 2016. We can also see that their ability to pay off this debt has also increased, and that they can pay about 27 times over. Lockheed has debt, and they could pay it off, but their ability to do so is decreasing. United Technology has the least amount of debt, but their ability to pay it off is below average, which makes us concerned. Overall, we like Boeing because they can afford their debt. Next is asset efficiency. Boeing and Lockheed are clearly more efficient than the others. We like Boeing more because they are more consistent. We like Lockheed less because they are less consistent. Lockheed's asset management has gotten better over the last 2 years. Their total asset turnover ratio has gone from below 1 to above 1, which we like. Next is profit margin and return on assets. We can see that Lockheed has decreasing ROA due to instability in their ability to turn over assets, and they have a largely decreasing profit margin. Their decreasing ROA is driven by their decreasing profit margin. Boeing has above average profit margin, and it is increasing going forward. So therefore, their ROA we can see is increasing due to their profit margin. And we know that profit margin is the driver because their asset efficiency is consistent, which we like. Next is ROE. And we can see that Boeing has significantly increased ROE. Why? Because they took on more debt. We know it's leverage because their EBIT margin is increasing, while interest and tax burdens remain the same. Lockheed has doubled ROE in the last year. Why? Because they received taxes back in 2016. And United Technologies' ROE is pretty inconsistent. They have really bad asset turnover. Next, market value. Market value lies with Boeing and Lockheed in this industry. We like Lockheed's EVA. It has been consistently growing. They made more than they were expected to for the last 3 years. Boeing's EVA has historically been positive until 2016. However, they did come back and make more than expected in 2017. We like both Lockheed and Boeing because they both have positive, higher EVA spreads than the others. Market liked Lockheed most consistently according to their price to earnings ratio. Boeing has significantly increasing market to book ratio, meaning that a high amount of cash flows can be generated from this based on what shareholders have in the business. And United has the most consistent price to earnings, meaning that the market continues to like them compared to what they've done in the past. Next, we will evaluate WACC and return on investment capital for Boeing and Lockheed. We like Boeing's WACC the most because it's more consistent over time. It's also the highest in the industry. Let's see, ROIC that is higher than a company's cost of capital indicates that the management is using the company's resources effectively to generate excess returns for every dollar of capital used in the process, and we can see that that is true for Boeing. Free cash flow. Obviously, Boeing has the most free cash flows, and theirs are increasing because of their earnings. We like them the most because they can pay more to shareholders and creditors. Supply chain. We don't like Lockheed Martin because they only have 22 customers, and 69% of that comes from the government. So if Lockheed loses government contracts, they will lose more than half their business. So we like Boeing the best because they have the most amount of suppliers in the group, and they have a good mix of customers aside from the U.S. government. Analysts recommend that this industry is expected to grow immensely in the next few years. We can see that it continues growing with the spending that Trump approved, further increasing that potential. And it's also a profitable industry to invest in because they have outperformed the S&P 500 historically. The industry winner for aerospace and defense is going to be Boeing. They have an average ability to pay off short-term liabilities. They have the most debt, but they also have the most ability to afford that debt. They're consistent with managing their assets and utilizing them wisely. They have increasing profit margin, which is increasing their ROE. They have great potential based on their price to earnings ratio. They have a stable WACC and increasing return on invested capital, and they have the most free cash flows.